What exactly are prediction markets?
Prediction markets are a way for ordinary investors to express their views on market-related events, some of which have very important consequences for one's investing. For example, we all know that elections have ramifications for markets. With midterm elections approaching, it will be very easy for investors to decide who they think has the better chance of taking the lead in the House of Representatives, the Senate, or in any range of specific congressional or gubernatorial elections. Prediction markets make that very simple. You can speculate on these races, or you can effectively use them as a hedge on your investment positions, but doing so in a much more targeted way than one was able to do before the advent of these products. This, to me, is the beauty of prediction markets. You can express a view on something that is market related or investment related, but that has always been historically difficult to factor into prices in a direct manner.
Walk us through the mechanics. How does one trade?
In terms of the mechanics, it's really not that difficult. You buy the yes if you think that the outcome of the contract will occur. You buy the no if you think it won't. And you also exit your contract by buying the opposite contract. So if you're long a yes, you buy a no. If you're long a no, you buy a yes.
Then how does one calculate profit and loss?
Prediction markets are quite straightforward. They trade at a value between 0 and 1. And these are dollar contracts, so you can speculate a little more in terms of the number of contracts because dollar value is low. And in terms of their percentage return, that's based on what you paid and the difference. So the leverage can be quite powerful because if I pay 40 cents for a given contract and it resolves at 1, I made 60 cents on my 40-cent investment. That's 150% return.
And what are some risk considerations?
One thing that we believe mitigates the risk is that these are financial contracts, not bets. These are financial contracts by a reputable financial firm with important financial regulation behind them. We believe that these prediction markets are a valuable tool for investors to speculate on or hedge risks that otherwise have not been easy to incorporate in one's portfolio. And that's why we feel very strongly about these products as investment tools and risk management tools rather than just purely speculative instruments.
Good morning, everybody. Welcome to today's live stream from Interactive Brokers. We're here on X and LinkedIn. My name is Andrew Wilkinson, Director of Trading Education, and to join me dissect today's numbers and implications for financial markets, Senior Economist Jose Torres. How are you, Jose?
Good morning, Andrew. Doing well. I've got these markets are a bit on a tear, and they are looking to extend their advance. With the S&P up around 0.7% in the pre-market, the NASDAQ really leading those gains. Really been a historic rally. Let's see if these numbers at 8:30 in 11 minutes can sustain, extend, or reverse.
So we've had the ADP report out earlier this week, and that gave us an addition in their opinion, or according to their data, should I say. The payroll processor said there were more than 100,000 jobs created in April. Last month, the official BLS non-farm payroll report came in at a sizable 178,000 with an unemployment rate at 4.3%. What are we looking for today, Jose?
Today, we're looking for a number around 73,000, according to our prediction market here at Interactive Brokers. However, when we look at more traditional economist consensus estimates, that's a little lower at 62,000 across the 43 forecasters surveyed in the monthly Reuters poll. The minimum forecast is negative 15,000 and the maximum is plus 150,000. So we know that the non-farm payrolls indicator is quite volatile. Let me show you all what we're looking at here on our prediction market.
And the prediction markets are just getting bigger and bigger everywhere, aren't they, Jose?
Oh yeah, oh yeah. So 9 minutes and 15 seconds, folks. The will it exceed 50,000? The yes at 50 is going for 63 cents. The no at 100 is going for 65 cents. So, implying a number around 73,000 here in the Interactive Brokers prediction market. And then here, like I said, 69 forecasters rather, negative 15,000 is the lowest estimate. So someone here that's on the low side would probably, if they participated in the prediction market, would probably want to go for the no here at 50,000 or the no at 100,000 for 65 cents. Conversely, those folks that are higher that think we're going to have a B, I think we're going to be at around the 100,000, but there's someone here that thinks that we'll be at 150,000. And that person could express that view by either buying really any of the yes contracts, depending on their risk tolerance, but the yes at 100,000 for 33 cents, or even the yes at 150,000 for 12 cents. Because in this case, a number above 150,000 would deliver $1 back on a 12-cent investment.
Yeah, that's all very interesting, isn't it? I'm not sure where I'd be inclined to go. I'm seeing the labour market now as the glass half empty. Would you agree with that, Jose? What is the health of the labour market overall?
Yeah, I think that the labor market is doing all right. I don't think it's doing excellent. I think there's certain factors, really three factors that are holding it back. Number one, you have the immigration restriction, and that's weighing on labor supply. You just don't have that many workers out there that you could recruit. Number two, you have the AI adoption. That's performing a lot of tasks that routinely were done by other employees. That's starting to make its way into the labor force and is blocking potential new entrants. Like the unemployment rate for new graduates is very high right now, according to a New York Fed study that was done last week. And then finally, rates are still far too high, even prior to the Middle Eastern conflict, but now, of course, even much higher. And that's weighing on the rate sensitive areas of the labor market, namely manufacturing, construction, and small business. Despite all the significant investment we're seeing on the manufacturing front, we see the ISM manufacturing index firmly in expansion territory. The sector is finally out of recession in a firm expansionary mode. Business investment is driving a lot of the GDP, even more so than consumption at this point, from a growth perspective, in terms of positive contributions to the headline number. But Andrew, despite all that, manufacturing sector from an employment standpoint continues to contract. So we'll see if this report out in 6 minutes will signal that the manufacturing sector started to inflect higher and started to add workers, or if it's going to keep we're going to have this investment heavy kind of manufacturing boom, but without much benefit for potential workers.
I've kind of got follow-up questions on all of that. Where would you, I mean, let's start with the manufacturing sector. This is the area that Trump was running on. Bring manufacturing back home. He keeps announcing like billions or trillions of dollars worth of investment coming back to the United States, but it's not manifesting itself in manufacturing jobs, and I'm not even sure that we're seeing that in construction at this point. What are your broad thoughts on that, Jose?
Yeah, I think I'm pretty pessimistic at this point, to be honest. Just because the trends have been so negative, but there is an alternative thought process that believes, or an alternative notion that believes that the manufacturing jobs will come after the investments in the data centers are complete. Then there's another view that supports the fact that automation and the robotics are really going to be doing much of the work in the factories. So you're not really going to need people. So, that's been, unfortunately, a headwind so far in the Trump administration in terms of being able to have the manufacturing sector expand from an employment perspective. Of course, in areas of the Rust Belt, a lot of those swing states like Pennsylvania, Wisconsin, Ohio, a lot of those states that can either be Democrats or Republicans at every election, swing states, we call them. A lot of them, they essentially went with President Trump in the 2024 election, believing that there would be some kind of manufacturing renaissance, some kind of, also, I think that nostalgic emotions of what a lot of those boom towns were back in the day. A lot of that nostalgia also gave Trump that emotional vote, that emotional bid, but without really the employee opportunities in the sector. That's been, so far, it's still early in the administration. We haven't finished the second year, but so far it's been particularly grim. I will say, however, that before President Trump got to office, we got to a high of 12.9 million post-COVID. So when he got to office in January 2025, we were at 12.6 million, and as of late, we're at 12.5 million. So, lost approximately 100,000 manufacturing jobs from when Trump began his term on January 1st, 2025 to March 2026.
So you say there may have been nostalgic voting for the president, but a lot of his base also voted for a lack of internationalism and no boots on the ground, no foreign wars and the rest of it. So that also, it turned out not to be true with the ongoing war and now the attempted ceasefire and peace talks in the Middle East. But the impact on the price of oil has been so significant, and it's likely to have a massive impact on consumers in the United States too, with gas prices going up to about, I think around $4.50 per gallon, according to AAA. We're not at the point where weakness in the labor market could really be used to justify lower interest rates either, at a time when we're changing from Powell to Walsh. What are your thoughts on what do we need to see from the labor market in order to press the Federal Reserve into acting?
Listen, Chair Powell, I think, has been too light on inflation throughout his tenure. I think that when you've had volatility in financial markets, Chair Powell has reacted far too aggressively and dovishly. And then when conditions improved and inflationary pressures began to reignite, he's far too late to rein him in. We're seeing same case here. Of course, we have the oil price shock, but prior to the oil price shock, we still spent over 5 years with the Fed not at the 2% target. And inflation expectations, Andrew, are increasing. They're increasing rapidly. I'm of the view of Neil Kashkari, of Hammack, of Logan, the regional presidents that dissented the Federal Reserve's decision to include a bias statement in the language. Andrew, April CPI is going to carry a 4 handle. It's probably going to be 4.2%. It could be 4.3. It could be 4.4. I don't see a path of 4% or under. It's 4.1 or higher. Why are we talking about cuts? I think the reason we're not talking about hikes is because that would disturb this significant market rally we've had. And of course, it seems that everyone's pretty happy with the price appreciation, including the president, the White House, the constituents, and this is being the appreciation in the capital markets is it's being championed and it's being celebrated by the administration as part of the policy wins. Earnings expectations have been rising significantly. I think part of that is 8:30 a.m. We'll get back to you in a second. Let's look at the number.
So ahead of the release, it looks like the stock market is jumping on the immediate aftermath of today's report. Whatever. Just interrupt me when you see the numbers, Jose. But I could see the 30-year around just above 5% and about 440-ish on the 10 years before this. See if I can find my rates page in Trader Workstation.
Yeah, we got 115,000 jobs in April, folks. Unemployment rate unchanged at 4.3%.
Any net
Markets, like
revision
Andrew
over that?
said, unbelievable. We have the high yesterday on the S&P was 73.85. That's an all-time high according to the futures market. We just missed it. We got to 73.84, but you can see this big green candle. It's the highest we've been overnight. So pretty strong reaction. Rates a little lower, actually. The 30-year down to 4.953, the 10-year down. So about 1 basis point lower across the curve. So just light, we'll see, could be knee-jerk reactions. Oil still at 95.02. Hedging in volatility protection instruments here, illustrated partially by the VIX, showing a little bit of a relief after seeing this number down to 16.9. Let's dive deep into the number and see which sectors drove the upward beat. So we have a pretty broad expansion here. Mining up 3,000, construction up 9, manufacturing down 2, wholesale trade up 6, retail trade up 22, transportation and warehousing up 30, utilities up 1.9, information down 13, finance down 11, education and health services up 46, leisure and hospitality up 14, other services up 10, and government down 8.
So once again, it's education and healthcare really driving half of this number.
Yes.
How significant is that?
I think that it's important because it reflects that we still have those constraints in the labor market, and the cyclical areas aren't really, haven't done that excellent. But in this report, though, Andrew, we have some kind of cyclical strength. I mean, retail 22, that's really strong for retail. Transportation up 30, so these are strong numbers. These are broad numbers. And if we pull up the ADP report from last month, we'll see that it also had broad strength across the report. Going back to the argument about the Fed, here's ADP's report from Wednesday, folks. Pretty green across sectors. Professional business lost 8. And BLS, professional business, gained 7. So, but still, broad strength across sectors. I think that it's a much better report than what we've seen. As far as why interest rates are holding, they're hanging in there. They're not falling much. They're down 1 basis point. But I would assume that based on these strong numbers and the unemployment rate stayed at 4.3, I would assume that interest rates would go higher. But they're not higher, they're lower.
So the revision added about 16. Sorry, reduced the last 3 months by about 16,000, according to the report today. Looks like the job losses in February were slightly lower at minus 133,000, whereas the March number was revised up by 7,000 to 185,000. So a slight drop April compared to March, but still, as you say, Jose, quite healthy. What's in it for the stock market?
Yeah, the stock market is here trying to make a new high at 73.84, albeit it's a pre-market high. We're doing really well. The Q's up to 701.26. Yesterday, they had a lot of trouble breaking 700. We had a lot of selling pressure there. Just showing you here what's been going on with the Qs. Yesterday, we exceeded the 700 level. This is a level that I've been watching for a potential exhaustion, potential reversal. There's been a significant rally, folks. So you got up above 700. You got to 701 and change, and the sellers came in, tried to take 700 again, failed, and finished around 695. So here, obviously today, the Qs. This has been the sector, the tech sector, folks, that's been driving this significant upside. I mean, look at this recovery from the March 30 lows, folks. Just absolute.
One heck of a rally.
Yes, just terrific, unbelievable rally. Here the Qs were stuck at around, between 650, 640, and 590 here for the first few months of the year. Everyone was doubting artificial intelligence, talking about maybe the CapEx numbers were too big. We had this drawdown down to the 550 area, folks, and now here we are past 700. It's going to be a big test. 700 is going to be a big test. These round numbers matter a lot. We saw the S&P, we saw the SPY ETF, similar story. In the beginning of the year, somewhat of a coincidence, it was really stuck under that 700 level, as you can see here, under that 700 level, and then finally broke out with force. And really, Andrew, as you can see here, after it broke past 700, really haven't seen any kind of a retest here. We got down to 702, 703. This is the SPY ETF that tracks S&P 500, one of the most popular. We've just been off to the races. A lot of it has been the White House. Really, in my opinion, the White House has really inspired a lot of optimism in the market, not necessarily a bad thing, by essentially continuing to reassure market participants that the Iran situation is under control, that the Strait will be open soon. The macroeconomic risks, Andrew, are significant. They are substantial. Consumers are already having a really tough time. We saw Planet Fitness earnings, Shake Shack earnings, Maersk, Honeywell, McDonald's, having a lot of trouble with higher costs. They are not really that positive about raising their costs and maintaining revenue. The margin pressure is real. But folks, that's the cyclical spots of the market. We do not have a market that's as cyclical, as consumer oriented as it used to be. It's more about CapEx. It's more about what cycle in the AI revolution we're in. And those players in the space, namely the hyperscalers, the semiconductors, and all the supporting firms around that, there's this expectation that these firms are going to be totally fine if we have a recession or we have an economic slowdown, which is definitely in the cards here, folks, just based on what we're hearing. Honeywell mentioning that the level of orders have been the worst since the great financial crisis. Of course, this could be that consumers are essentially saying, all right, let me pare back. Let me wait for this one-time shock to pass, perhaps. Oil prices to go back down, gasoline to come down, the uncertainty to subside, and then we'll resume spending. But there's also, of course, the opposite argument that argues that the consumers have essentially, they don't have much left in the tank. Kraft Heinz also. So hearing a lot of these same comments from the more cyclical firms in the market. As far as foreclosures too, real estate sector looking really weak. Foreclosures ticking higher, nowhere near the 2008 financial crisis. Of course, this equity is so strong in the residential property. So making mortgage workarounds, very popular for those borrowers that are under duress. Yeah, we'll see what happens. This rally has shocked me because I think that from January 1st to now, the risks to earnings, the risks to the cycle are substantially higher, right? But the market doesn't care about that, folks. The market is the market, and the animal spirits are off to the races. And AI is apparently going to power earnings for ages to come. So that's what we got. One thing I'm really worried about, I haven't spoken about yet, the earnings expectations, the pricing power from a lot of these semiconductor firms. Firms like Micron, firms like Samsung, Sky Hynix, Texas Instruments, Intel, all those firms. There could be a case that the earnings expectations are significantly higher, folks, because once the war started in February, corporates started scrambling for supplies ASAP because of the risk that potentially the war would extend, and then supplies would be hard to come by later, would be hard to acquire later. So there is a chance that this whole earnings lift, this rise in expectations, has to do with the significant inventory buildup due to the Middle Eastern conflict and not to actual pricing power. Another thing I'll say, those firms, these are the most traditional boom and bust kind of revenue prospects and margin prospects. If you go back, for example, you look at AMD on the chart, significant rallies followed by significant drawdowns. Every time throughout those cycles, there's an anticipation by the bulls that, oh, this time is different. This time, this technology is absolutely essential. There's nothing like it. There's going to be no competitors out there. And for that reason, pricing power is going to remain robust. But then this time could be different, but it just seems that revenues start to decline. Pricing power starts to soften pretty quickly because it is hardware. These are like technological commodities in many cases. So, we'll see what happens. Of course, the needs for these chips now are higher than ever. So there's the chance that this time will be sticky, but it is important to understand the historical context, as well as understanding the fact that, GDP has been pretty slow, and the NASDAQ is up double digits already year to date, following 3 consecutive years of gains around 20 to 25% or so. So, at what point do we have some kind of an alleviation in the lift in stock prices, or is this the best bull market ever? Only time will tell.
Mm-hmm. Jose, I want to come back to a couple of points you made earlier. You were talking about some of the companies that have recently reported. I want you to comment, if you will, on Whirlpool earnings and why they cut their dividend to 0, as well as what's going on at McDonald's. What was McDonald's commentary?
Yeah, McDonald's, essentially, they're finding that they can't raise prices. Folks remember McDonald's as a place where you bring, maybe on a lazy evening or a Sunday lunch after church or something like that, or after whatever, you would take the family there, you, your wife, 2, 3 kids, maybe a few grandkids, whatever, and you would spend $40 or $50, maybe $20 or $30, depending on the number. But now those bills are a lot higher. Those bills are more like premium dining. It's almost double in many cases. So McDonald's is having trouble managing input costs, which are significant, food and fuel and wages, against the backdrop of consumers that have associated the brand with being a cheap dinner, a cheap lunch, an inexpensive place to dine. That dynamic has shifted rapidly. So that's what McDonald's is worried about, the consumer just not being able to afford its traditionally affordable products. Now, Whirlpool,
one of the big problems there is rising beef prices, in fact, surging beef prices.
Yeah, surging beef prices. The Strait of Hormuz, the closure, has really negatively affected the fertilizer supplies, and farmers here in the U.S. are, having significant issues with that. So that's, of course, that's lifting costs, of course, diesel, gasoline, transport, wage pressures, against the backdrop of a consumer that has learned that this food is supposed to be, cheap and historically, and McDonald's is having trouble managing those expectations. Planet Fitness too, similar kind of brand where folks that are working their way up. They're more middle class, more in the working class folks. They'll go to the gymnasium, pay $10 a month, I believe. There was an expectation by Wall Street, by the analysts, that Planet Fitness would raise its costs, but because of consumer pushback, that expectation has really declined. And then Whirlpool is just saying that no one wants to buy any durable goods. They're too pricey, number one. Number two, interest rates are sky high. A lot of folks, they finance those purchases. And they mentioned that transactions were the worst they were since the global financial crisis. Of course, like I said earlier, throughout this cycle, we've seen bouts of light switch spending. The consumers turn it off and the consumers turn it off. They turn it on, then they turn it off. So, that's something that is real, and it could be occurring again this time. Or it could be that, we're heading into recession. There's a chance. Some, prediction markets, the chance isn't 0. It's around 30%. Different shops on Wall Street are, between 20 and 50%. So, there is a chance that we go into a slowdown here. And oil price shocks have been associated with slowdowns. It's just that $100 oil, when you consider inflation, isn't that tight as $150 oil was in 2008, or $20 oil was in 2022.
Yeah. You can direct any questions for Jose in the chat there. Just raise a question on X or LinkedIn at Interactive Brokers, and you'll get through to us, and we'll try and deal with any questions. Jose, what's the impact on the prediction market here? I was thinking the glass half empty beforehand. Now we've had, as it turns out, two back-to-back 100,000 plus job reports. So what does that mean for the May job report, or even initial claims? I noticed last week came in at sub 200,000, did they not?
Yeah, 57-year low in 57-year low in initial claims. So very, very subdued. As far as the revision to last month, to February, was particularly March, was pretty unchanged, like you said. So that, that was good news. As far as what I see going forward, I mean, this definitely doesn't strengthen the case for cuts. Although the Treasury complex is a little lighter, I think, going into the weekend, there could be a case where folks are a little positive that we could get a deal done between the U.S. and Iran. So I think that's pulling.
Doesn't it feel that way, Jose? It's rather than being worried on a Friday afternoon, I think there's more optimism now. Would glass half full in that sense on progression of peace talks?
Yeah, definitely. And what shocks me is that whenever there's a step back in optimism or in conversation, the market reaction is very modest. But whenever there's any kind of talking points that's positive, like, oh, the deal's around the corner, the market reaction is astonishingly bullish. So we'll see what happens here. We have 28% chance of recession by this year, essentially. So 2 consecutive quarters to sort of require Q3 and Q4 to be negative. So let's see what happens with that. Yeah, I mean, we're close to double-digit gains on the S&P so far this year. Only May. Have Fed chair around the corner, have midterms around the corner. So we'll see how investors can digest all of that. If inflation's high and Warsh comes in and he wants to be loose, then the market can keep running, folks. Central banks that tolerate above target inflation, that means that you're letting the economy run hot, and you're letting speculative enthusiasms thrive in an environment of above average price pressures, above target, above objective rather. So that's very positive for stocks. However, if Warsh comes in and he's more hawkish, then, that could be a very negative backdrop, because CPI is 4.2, folks, 4.3 for May. We might not get below 3.5 all year. How long is a U.S. central bank going to allow inflation to be significantly above target? And in defense of its employment, financial stability mandates, what are they ever going to pay more attention to the price pressure mandate?
Jose, what's the next big piece of economic news?
CPI on Tuesday the 12th, and that's when we'll join again. Looking forward to that. That'll be, of course, it'll be a repeat of the crew, not too far away, only this Tuesday. I'll be in the tri-state area. I'll be flying up north to do media interviews and to see some of our teammates at Interactive Brokers at our headquarters in Greenwich. So I won't be here in the West Palm Beach studio. So the backdrop will be a little distinct. However, we do invite you to come join us again on Tuesday. And then we do have our Spanish one towards the end of the month with Judy Casasampere. Thanks so much, Andrew, for being here, as always. And ladies and gentlemen, thanks so much for joining. And before we go, we will play just another We're Here thanks to the Interactive Brokers prediction market. We're going to play a short commercial before we go.
Thanks to the audience for joining us. Thank you, Jose Torres.
My pleasure, Andrew. Thanks for being here. Bye.
Bye for now.
Prediction markets are a way for ordinary investors to express their views on market-related events, some of which have very important consequences for one's investing. In terms of the mechanics, it's really not that difficult. You buy the yes if you think that the outcome of the contract will occur. You buy the no if you think it won't. Prediction markets are quite straightforward. They trade at a value between 0 and 1. And these are dollar contracts, so you can speculate a little more in terms of the number of contracts because dollar value is low. And in terms of their percentage return, that's based on what you paid, and the difference. So the leverage can be quite powerful, because if I pay 40 cents for a given contract and it resolves at 1, I made 60 cents on my 40-cent investment. That's 150% return. This, to me, is the beauty of prediction markets. You can express a view on something that is market related, but that has always been historically difficult to factor into prices in a direct manner.